So you're thinking about dipping your toes into the stock market, and you're looking at a company you know and probably use every week, Netflix. It seems like a logical first step, right? Buy stock in a brand you understand. Before you click that buy button, I need to give you the honest and varnished truth about whether beginners should invest in Netflix stock. This isn't about whether Netflix is a good company, it's a phenomenal company that revolutionized entertainment. This is about whether a single, volatile stock like Netflix is the right first step for someone learning to invest. We're going to break down the three massive risks you face as a beginner buying Netflix, the crucial investing principles you haven't learned yet, and the alternative strategy that builds real, lasting wealth with far less sleepless nights. Let's get into it. The first and biggest concept you must understand as a beginner is specific risk, also called systematic risk. This is the danger that something bad happens to one specific company. Let's talk about volatility and emotional risk, which is where most beginners get wrecked. Netflix is not a stable, sleepy stock. We're talking about moves of 10%, 15%, or even 20% in a single day after earnings. As a beginner with a small portfolio, a 20% drop on a stock that represents a large portion of your money is terrifying. What do most people do when they're terrified? They sell at a loss. They lock in that permanent loss of capital. This is the most common and costly beginner mistake, buying high out of excitement and selling low out of fear. You haven't yet developed the emotional discipline to ride out that volatility. You haven't lived through a full market cycle where a stock you love drops 50% and takes 2 years to recover. Buying a slice of Netflix exposes you to that emotional roller coaster immediately, and it's a terrible way to learn. The insider perspective is that seasoned investors build positions over time, use dollar cost averaging, and have a diversified portfolio so a drop in one holding doesn't dictate their entire financial mood. You, as a beginner, likely don't have that structure yet. Starting with highly volatile assets is like learning to drive in a Formula One car. It's a fast track to a crash. Now, let's contrast this with the principle of diversification, which is your greatest tool as a beginner. Diversification simply means not putting all your eggs in one basket. When you buy a single stock like Netflix, all your eggs are in the Netflix basket. The alternative, and the universally recommended starting point by virtually every legitimate financial advisor, is a low-cost, broad-market index fund or ETF. Think of an S&P 500 index fund like VU or SPY. With one purchase, you instantly own small pieces of 500 of America's largest companies, including Netflix. You get exposure to tech, healthcare, finance, consumer goods, everything. If Netflix has a bad year, Apple or Microsoft might have a great year, and your overall investment stays much more stable. You're betting on the entire American economy's growth, not on one company's ability to guess what we want to watch next Thursday. This is how you learn. You invest consistently in a diversified fund, you watch how it moves with the broader market, You learn about dollar cost averaging. And you build the habit of investing without the nerve-wracking stress of a single stock's drama. This is the foundational step almost every beginner skips because it's not as sexy as saying you own Netflix. But skipping it is the single biggest strategic error you can make. All that said, if you are absolutely determined to buy a small piece of Netflix as a learning experience, we must frame it correctly. You need to treat it as a tuition fee for your financial education, not as a serious wealth-building move. That means following strict rules. First, position size is everything. It should be a tiny, almost insignificant portion of your total investment capital. Think 1% to 5% at the absolute maximum. Money you are 100% prepared to lose without it affecting your goals or your emotions. Second, you must do the homework. Don't buy it because you like Stranger Things. You need to understand its financials, its price-to-earnings ratio, its debt levels, its free cash flow, its competitive threats. You need to read its quarterly shareholder letters. This process itself is education. Third, you must have a plan before you buy. Write down, why am I buying Netflix? At what price will I reevaluate? What would have to change for me to sell? This enforces discipline. The common mistake is to buy on a whim, then rationalize the decision later as the stock falls. By having a written plan, you separate emotion from action. This small, controlled experiment can teach you more about market psychology than any book, but only if you approach it with this structured, risk-managed mindset. Finally, let's build your actual beginner's action plan. Step 1 is to establish your foundation. Open a brokerage account with a reputable platform like Fidelity, Vanguard, or Charles Schwab. Before you even look at Netflix, set up an automatic monthly transfer to buy a broad market ETF. This is your core holding. Step 2 is to fund an emergency savings account with 3 to 6 months of living expenses in a high-yield savings account. This is your financial cushion so you never have to sell investments in a panic. Step 3. If you have money beyond that and the burning curiosity, then and only then, allocate that tiny learning portion. Maybe it's Netflix, maybe it's another company you're passionate about. Use the rules we just discussed. This framework protects you. You're building a resilient financial house with a solid foundation: index funds, a sturdy roof, emergency cash, and then maybe you add a decorative weather vane, your small Netflix position on top. The weather vane doesn't hold up the house, but it can tell you which way the wind is blowing. I must conclude with a critical disclaimer: this content is for informational and educational purposes only. It is not individual investment advice, a recommendation, or an offer to buy or sell any security. Investing in the stock market involves risk, including the total loss of principal. Past performance is no guarantee of future results. Your personal financial situation, risk tolerance, and investment goals are unique. You are solely responsible for your own investment decisions. Before investing in any security, including Netflix or index funds, you must conduct your own thorough research or consult with a qualified, licensed financial advisor. Never invest money you cannot afford to lose. So, should beginners invest in Netflix stock? The responsible answer is not as a core, foundational investment. Your first and most important investment should be in your own financial education and a diversified, low-cost portfolio. If you choose to buy a sliver of Netflix, do so with eyes wide open, as a small, educational experiment with strict risk controls. The goal for a beginner isn't to pick the next big winner, it's to build a system that wins over time. If this framework makes sense to you, do me a huge favor and hit that like button. It helps more than you know. Subscribe for more plain talk financial education. In the comments, let me know, are you building your foundation first, or are you tempted to jump straight into single stocks? Thanks for watching, and here's to making smart, informed decisions with your money.